If you're an owner-operator running your routes, pulling heavy freight, and making over $80,000 a year while remaining taxed as a default single-member LLC, you are quietly volunteering to hand over thousands of dollars in unnecessary wealth straight to the Internal Revenue Service every single year. The fix for this systematic cash drain is a single, clean structural election that most commercial drivers and independent contractors have never had explained to them in plain job site English. Today, we are lifting the hood on the American tax code to look at the exact mechanical line where your current business setup stops protecting you and starts acting as a massive financial leak. When you first earn your commercial authority, buy your first rig, or register your independent logistics business entity, the standard advice you get from state registries, online document filing portals, and basic retail accountants is always the same. They tell you to set up a standard limited liability company. On the surface, this is excellent advice because an LLC provides a vital, foundational legal shield that separates your personal savings, your primary home, your family vehicles, and your private assets from your commercial road risks, highway liabilities, and freight contract disputes. But what your local document filing service or automated online incorporation website completely fails to mention is that a standard single-member LLC is entirely invisible to the federal government. By default, the Internal Revenue Service classifies and treats a single-member LLC as a basic sole proprietorship for tax processing purposes. This means from a tax compliance standpoint, the government does not recognize your trucking business as a separate corporate taxable structure. Instead, every single dollar your truck clears after deducting your fuel, your commercial insurance premiums, your brokerage percentages, and your heavy equipment maintenance is viewed strictly as personal self-employment income generated by you as an individual. And that is exactly where the legally approved trap snaps shut on your business revenue. Every single dollar of that net business profit is instantly hit with a flat, non-negotiable 15.3% self-employment tax. Let's freeze right here for a second and examine this clearly, because this is where standard neighborhood tax preparers completely lose their clients. That 15.3% self-employment levy is not your regular state or federal income tax bracket. That is a flat structural employment tax designed to cover Social Security and Medicare contributions, and it is taken completely off the top of your net earnings before you even factor in your standard deductions, your personal exemptions, your dependents, or your write-offs. Now let's run the actual cold numbers for an independent operator clearing a net profit of $90,000 a year after standard road expenses like diesel and tires. Under the default factory settings of a single-member LLC, that flat 15.3% self-employment tax takes over $13,700 straight out of your settlement checks before you even pay your standard marginal income taxes. Think about that scale. You are essentially handing over a massive down payment for a brand new trailer or a complete engine overhaul straight to the government every single year, simply because your business paperwork was left on the default configuration it came with. To put an end to this leak, you do not need to dissolve your LLC, close down your authority, change your operation, or hire a high-priced corporate team. You simply need to instruct the Internal Revenue Service to alter your tax classification status to a subchapter S corporation by filing a document known as IRS Form 2553. Before we map out the exact compliance rules, the administrative catches, and the specific net income threshold where this structural switch becomes highly profitable, drop a comment below with your current quarterly net revenue range. Let's look at where the average owner-operator is tracking in today's freight economy. Let's dive deep into the underlying mechanics of how an S-Corp election acts as a powerful financial shield for your logistics business. When you execute this tax classification change, you fundamentally transform how the United States tax code views your incoming capital. You're no longer categorized as a self-employed individual drawing random profit shares from a default business structure. Instead, the government now views your business as a distinct corporate taxable entity, and you legally become an employee of your own trucking corporation. This structural shift allows you to mathematically divide your net operating profit into two completely separate, distinct financial buckets. Bucket number one is designated as your official regular W-2 employee salary, which you pay yourself through standard payroll processing. Bucket number two is classified as your corporate business distribution, which represents the remaining profit of the corporation passed through to you as the shareholder. Why does this specific structural split completely change your wealth retention strategy? Because the Internal Revenue Service is legally restricted to charging that brutal 15.3% self-employment tax only on the funds inside bucket number one, your employee salary. The remaining net profit that flows directly into bucket number two as a corporate distribution completely bypasses self-employment taxes by law. You still pay standard federal and state income tax on that distribution money, but you have successfully and legally shielded it from the top-off 15.3% employment levy. Let's trace the exact comparative math on a standard trucking operation netting $95,000 this year after all equipment costs so you can see the recovery plain and clear. Under a default single-member LLC setup, you pay the 15.3% employment tax on the entire $95,000, which equates to an immediate $14,500 liability. But under your new S-Corp status, you set a reasonable, defensible W-2 salary for yourself based on the standard average wage for commercial company drivers in your specific region. Let's look at $50,000 as a baseline example. Your corporation runs standard payroll, holds back the appropriate withholdings, and pays the employment taxes on that $50,000. Now look at what happens to the remaining $45,000 of your net earnings. You pass that money through to your personal account as a corporate business distribution from bucket number 2. Because it is a distribution, that entire $45,000 block completely avoids the 15.3% self-employment tax. That single, simple paperwork adjustment saves you roughly $6,885 in a single tax year. Over a 5-year stretch on the interstate, that translates to over $34,000 of your hard-earned money that stays inside your operating capital account instead of leaking out to the federal government. But wait, it gets even more impactful when you look at how that extra cash compounds if you actually deploy it properly instead of spending it on lifestyle upgrades. If you take that saved $6,800 every single year and deploy it automatically into conservative, low-cost, broad market index funds tracking the total economy at a realistic historical average long-run return of 8 to 10%, that tax recovery alone turns into over $60,000 of clean wealth in less than 7 years. If you extend that timeline across a 20-year career on the highway, that single corporate selection turns into over $300,000 of additional retirement capital. You are literally funding your own early retirement and building generational wealth using money that you are currently throwing away simply due to a paperwork omission. But before you rush out to execute this paperwork today, we need to talk about the real administrative catches, because an S corporation requires strict internal discipline, consistent bookkeeping, and it is absolutely not free to run. The first critical hurdle you must navigate is the strict Internal Revenue Service guideline regarding a reasonable salary. You cannot legally set your corporate W-2 wage to a token amount like $10,000 a year just to avoid paying employment taxes on the rest. The Internal Revenue Service is highly aware of this strategy, and they actively monitor transportation entities to ensure your salary reflects what an independent outside logistics company would pay a driver to operate your exact class of equipment. If you set your salary too low to aggressively duck taxes, the government can flag your corporate return for an audit, reclassify your entire distribution bucket as employee salary, and hit your business with massive back taxes, interest charges, and heavy accuracy penalties. You must work with an experienced professional to lock in a defensible salary range based on real geographic labor data. The second major catch is the added operational compliance overhead. Running a true S-Corp means you can no longer just mix your funds or take random cash draws whenever you need money. You must utilize formalized payroll tracking software to withhold federal insurance contributions, pay state unemployment taxes every single month, file quarterly corporate employment tax updates, and file a completely separate corporate tax return known as Form 112-0-S at the end of the fiscal year. This added layer of professional compliance means your annual accounting fees will inevitably go up. A specialized logistics accountant will typically charge you anywhere from an extra $1,000 to $1,500 a year to manage your corporate payroll, file your corporate forms, and keep your entities in good standing with the state. Therefore, your net self-employment tax savings must comfortably clear this baseline entry cost to make the switch logical. At that lower volume, the ongoing costs of payroll processing software, state corporate registration fees, separate tax preparation software, and accounting overhead will burn through almost all of your self-employment tax savings, leaving you with nothing but extra paperwork, administrative headaches, and zero net financial benefit. But the very moment your net operational profit clears that $60,000 to $70,000 marker, the geometric scalability of the S-Corp shield takes over, and the corporate entity structure wins by a landslide every single time because the tax savings scale exponentially higher while the accounting overhead stays completely flat. Let's look at the broader landscape of the modern logistics industry to put this into perspective. The independent operators who survive major freight recessions and down cycles are never the ones who are just chasing lucky spot market loads or working 80 hours a week until their bodies give out. The survivors are the elite business operators who treat their back office with the exact same mechanical precision they use to maintain their diesel engines. If you are running a business, you cannot afford to have mechanical failures under the hood of your truck, and you certainly cannot afford to have structural leaks inside your financial layout. Managing a successful freight business is only 50% about what you earn on the highway. The other 50% is entirely about your corporate architecture and how much of that revenue you actually keep. Stop volunteering your hard-earned cash to the government due to outdated business tracking and start driving toward real financial freedom on your own terms. To help you calculate your exact corporate threshold, map out your S-Corp transition steps, and systematically track every single legal operational deduction before the next tax quarter closes, I've put together a comprehensive, step-by-step, free owner-operator tax and deduction checklist. This playbook outlines the exact transition criteria, payroll setup milestones, hidden in-cab write-offs, and compliance guidelines you need to hand directly to your CPA to ensure your business structure is completely airtight. Click the top link in the description or check the pinned comment right now, drop your email, and download the checklist completely for free to protect your fleet. Take control of your structural cash flow, seal the corporate leaks, drive safe, and build your own blueprint.